Welcome to this week's Current Federal Tax Developments for the week of September the 10th, 2018. Current Federal Tax Developments are brought to you by Kaplan Professional Education and by your state Society of CPAs. This week we have a lot of things to talk about because the IRS, in attempting to clarify a situation, appears to have created a bunch of confusion. We'll talk about where we stand now with the state and local tax workaround regulations that the IRS this week apparently published a workaround for the workaround regulations. We'll also talk about South Dakota actually going to be holding a special session. So believe it or not, the victor in the case of Wayfair versus South Dakota actually is going to be a late to the game state to actually be able to start collecting sales tax under these rules because they had to make some law changes. We'll talk about a case of a taxpayer who misunderstood the exception for monies coming out of an IRA not being subject to 10% early excise tax if it comes out in regard to an IRS levy. We'll talk about the issues that involved an IRS memorandum that talked about seismic fees for offshore drilling and how those costs had to be handled. The president issued an executive order to the Department of Labor and Treasury to see if they could make some changes to rules regarding retirement plans. And the tax court disagreed with the IRS's view on how Section 1239C gains from PFICs are handled with regard to the 6-year statute of limitations. Let's get going this week, and let's start with the state of South Dakota. This is a case of South Dakota proposed revenue bills 1 and 2. They were issued on August the 31st of 2018. They were rolled out by the governor of South Dakota, who is now looking at needing to call a special session. And the issue is why? Well, although South Dakota won in the case of the Wayfair case, South Dakota won in the sense that, they overturned the ruling that said, oh, South Dakota, you can't impose this tax. But the Supreme Court actually just remanded the case back to the state of South Dakota and to their courts to deal with potential other objections to the application of the tax. So when the case left the Supreme Court, they hadn't actually said, South Dakota, you can collect the tax. Now, that creates a problem because South Dakota, Wayfair, Newegg, and forget the other party involved in this particular case, they're still negotiating the final deal rather than going back to court as to how they're going to settle their cases. But that means for the moment that South Dakota's kind of stuck because they haven't yet had a full resolution. So South Dakota, noticing that everybody else was going ahead at this point because, the Supreme Court did everything but give an absolute green light to say that this is all fine, South Dakota is now going back to modify the rule. Now, the South Dakota proposed revenue bills do a couple of things. The first thing that happens under these bills is it would remove, currently South Dakota was barred from enforcing this law until such time as, if there was a case that challenged it, until such time as that case was fully adjudicated. And as I said, at this point, the case hasn't been fully adjudicated. So what the governor wants South Dakota to do is come back into session, the legislature, and pass a law that, except for those three, will now say for everybody else, the law is going to apply to you. You need to start paying the tax. The other three, will take care of them as we settle this case. And of course, since they were the first ones in and they were the ones to challenge it and stop the law from going into place right away, basically they're the first ones in because South Dakota picked them. They're the ones who are still going to be on the hook now. There's no question. But now we're going to bring everybody else onto the hook. This law, if passed by the legislature, would take effect on November 1st. And it has everything that we already had about the South Dakota law, except we get rid of that bit that says we're not going to enforce this law until we fully adjudicate the cases. It would take effect on November 1st. So your clients who may be selling more than $100,000 worth of sales into the state of South Dakota, or 200 transactions in a year, those clients will need to start collecting and remitting the sales tax on November 1st of this year, assuming this bill passes the legislature, which it seems highly likely it will. Be a little strange for South Dakota to go to all this trouble, go to court, have the legislature pass a specially crafted bill to set this all up, and then suddenly say, hey, forget it, we're not going to do this. So let's assume that South Dakota's legislature will actually do this. And so on November 1st, you'll have to start complying with it. But the South Dakota bill did miss something that a lot of other states started picking up after the South Dakota law was done. South Dakota adds marketplace provisions. So if you are a marketplace, in this case, think like eBay or people selling via Amazon, who do the sales, being those partners with Amazon. A marketplace now that meets the requirements will have to collect for its sellers. Now, the way this generally works is the marketplace provisions generally work like this. The marketplace is supposed to collect, but it is kind of a joint liability. If the marketplace fails to collect, your client's still on the hook, and of course the marketplace can't say the client should have collected. That's how that works. So basically, an information goes from the seller to the marketplace. If the seller gives the marketplace vendor bad information, like for instance, saying that all the things they're selling in South Dakota are exempt from sales tax, for some reason, and then turns around, hey, no, they're not. That's not how it works. In that case, what they're selling doesn't meet all these technical requirements to be exempted. Then, the marketplace gets some exemption for a while. Those rules, again, would take effect November 1st. So interestingly enough, one of the last states to be able to jump on, not one of the last, but they're, the majority of states that already now have systems in place. It is interesting that South Dakota is in the last half of states who actually can start benefiting from the course, or from, I should say, the case that South Dakota brought. Next up, we're going to talk about a case here of Thompson versus United States. This is case number 3:18-CV-01675. It's from the U.S. District Court of the Northern District of California. The case came down on August the 30th. And this case deals with a taxpayer who misunderstood a rule regarding when a taxpayer does not owe the 10% early distribution tax under Section 72T. In this case, here's what was happening. The IRS had a tax, issue going against this person. This person, was going to owe a bunch of money. So this person went around and basically withdrew a lot of money from the IRA account. Now, they did so in this case after the IRS had sent them a notice, or basically a notice of intent to levy. But the IRS had not actually issued a levy at that time. Now, the taxpayer said, well, hey, the IRS said they were going to levy. I just went ahead and took it out. I did that because it would have been really damaging to my business had there been an actual IRS levy process started. So instead of letting the IRS start the process, which eventually they might have gone in and grabbed the money from the IRA, I just took the money from the IRA, and it was clearly under threat of levy. So the taxpayer says, because the law says if the IRS takes the fund, under a levy, that the 10% penalty is not owed, then I shouldn't owe the 10%. The problem is, as the court pointed out, this taxpayer hadn't actually been levied. And if you're not actually levied, then, the court points out, the 10% tax is going to apply. Why? Because the law only exempts actual IRS levies. Now, obviously, the taxpayer said, but wait, they were threatening to do it. And the court said, well, threatening to and doing is not the same thing. And secondly, as you kind of told us, you did that because an actual levy would have been damaging to your business. So you didn't want to have the situation occur that actually would have gotten you out of this 10% tax. This is important because it's important to understand, be very careful reading exceptions. This case, in this case, nobody's claiming that they were told this by somebody that was okay to do this. But this is the type of mistake I can easily see a tax professional making. There is a threat of levy. This rule says we don't owe it if it's a levy. You have to understand, be very careful on exceptions. If you really want this to do this, you need to negotiate with the service to tell them, look, what I want you to do is I want you to issue the levy, take it from the IRA account, and that, because that's where the money is, that's where it's going to have to come from. So take it from the account, and at that point, then we get out of the 10% penalty, and you get your money, and we're all happy. So that's how we'd like to do it. And if that's okay, we'll go ahead with it. But the do-it-yourself option here, which is what Thompson did, it just really doesn't work. And in this case, it costs the taxpayer an additional 10% tax on the distribution that otherwise would not have been due if he could have just, waited till the IRS actually attempted to go after the money. Now let's go on to the thing that actually got the most attention this week. This is a pair of documents issued on the 5th of September. It was an IRS news release, IR 178, and the Department of Treasury issued a release quoting the Treasury Secretary at the same time. These releases were meant to be a clarification, is the term the IRS used, in the regulations that we had discussed a couple weeks ago that the IRS released regarding the state and local tax workaround rules. You may remember those proposed regulations said if you make a contribution to a, whatever organization it may be, it could be a state fund set up, it could be a, it could be a charity, it could be whatever. But in exchange for that contribution, you get a credit in excess of 15% against your state income taxes or state property taxes. Well, income tax, what they're talking about here. You get that credit in excess of 15% on income taxes. You have to reduce that donation by the credit. Okay, great. That one was actually fairly simple to understand. We make a contribution, we get a credit. That credit's more than 15% of the contribution that we made. We have to reduce it, okay? No questions, simple, easy, quick to apply. But as you may have noticed, on the same day that the reg came out, the chairman of Ways and Means, Chairman Brady, issued a document that his statement on it kind of issued that he was taken by surprise because the catch is there were a lot of credits pre-existing the Tax Cuts and Jobs Act that offered this benefit, and based on, as we discussed at the time, the 2011 Chief Counsel advice, we had been taking the full deduction for the charitable contribution, even though we got the credit. And so Chairman Brady suggested that those who had things like school tuition programs that had been using this, and there were a lot of school tuition programs that various states had set up that did exactly that. Here in Arizona, it's 100% credit. You give the amount to the school tuition organization, you get a dollar for dollar credit. It's not like 80% or 60%. It's the whole thing. And under that Chief Counsel advice, many people in Arizona, of course, had been saying, well, I'm going to make a $1,000 contribution to the private school tuition organization. I'm going to get $1,000 off my Arizona taxes, so I'm basically even. But then I'm still going to claim the $1,000 itemized deduction, therefore potentially getting me, the idea was $396 of benefit. Now, as was pointed out before, back prior to this year, that really wasn't a benefit if you thought about it as much as it might seem, because had I not made that contribution, I would have owed Arizona $1,000, and that $1,000 I paid to Arizona would have been a deductible expense unless I was subject to the AMT. So if I was subject to AMT, then yes, I made $280 most likely off of making the contribution, because I got all my money back from the state of Arizona, reducing my Arizona tax, and my federal tax dropped by $280 under the AMT. But for taxpayers not subject to AMT, there was no difference. Well, obviously, Treasury having issued those regs, suddenly those programs would now also face this reduction. There was lots of whining about this, shall we say. Certainly lots of complaints were issued. So the IRS issued a clarification this week, and it's kind of interesting. The IRS says, please note, there's been no change to the allowance under Section 162 for payments made to the charities that are related to your trade or business. Now, that's an interesting clarification. What's interesting about it, a couple things interesting about it. First, it's interesting that, given the immediate response and giving the, the Ways and Means Committee chairman's response, that if this was an obvious clarification that we obviously never intended this to change, it would have made sense to issue it at that time as to why it took this long to come out. As the first question. The second question is, it talks about, and the Treasury Secretary specifically talks about, we're doing this, we're going to, there's no change to existing law. That sent a few people scrambling. What in the world is existing law? Well, what it's referring to, if you go take a look at Regulation 1.170, Cap A-1C5, that regulation talks about, when a payment made to a charitable organization by a business may nevertheless be a 162 trade or business deduction rather than a 170 charitable contribution. Why is that important? Well, those of us who have been in practice for quite a while, like myself, and go back to prior to the 1986 Tax Act, we remember having a lot of closely held C corporations. And I'll give you a little hint about those days. Those closely held C corporations often had very little income, intentionally, because people, and I hate to say it, but people would intentionally bonus out money to make it just perfectly bring the taxable income to where you only paid at the lowest corporate rates on the first $25,000. And they do that until they accumulated too much in retained earnings, or not really retained earnings, but accumulative earnings, which is a different concept. But until you got close to worrying about that tax, you'd keep accumulating at these low brackets, at least if you needed any capital or there was a reason to retain it inside. Well, the problem there was if you did, let's say, make a payment to a charitable organization and your income was, let's say, no more than $25,000, if you made a $5,000 contribution, you're going to go over the 10% of taxable income limitation. That's the maximum allowed for a charitable contribution for the C Corp. So for that reason, there's a lot of rulings, and that explains, by the way, when you look at these rulings, why the vast majority of them are from the 70s. There was a series of rulings that came down that talked about situations when a contribution, when a payment to the charity is not a charitable contribution. You need to meet two tests. Test number one of this regulation, the expenditure must be directly related to the taxpayer's trade or business. And number two, the expenditure is made with a reasonable expectation of financial return that is reasonably linked to the payment made. So the idea is I'm making this payment to the charity. And I'm doing that because I'm betting it's going to basically help me more than what I'm giving up. For instance, some of y'all, I'll give an example of one I'm almost certain is being claimed as a 162 expense. Some of you may be aware of Amazon Smile program, right? Smile.amazon.com. And you set up your account in that program. So when you go in via Smile, when you make when you buy something on Amazon, a percentage of purchases that are Smile eligible, which is most purchases, at least that come from Amazon directly, a portion of your purchase then is paid to a charity that is signed up with Amazon. You've selected, and there's a huge list of charities that have signed up with Amazon. The idea there is Amazon is paying that to a charity, but it's not really a charitable contribution. Amazon is doing it because, hey, you know that if you go buy this thing from Amazon, that, a percentage of what you pay for it is going to go to your favorite charity, be it your local church, be it, the Red Cross, be it a food bank, whatever it is, the payment's going to go there. So you go there and buy it from Amazon rather than going and buying it from, let's say, Target or Walmart or whoever else you might have bought it from. You buy it from Amazon. Well, Amazon's theory is they get a sale, and while they're giving up a small portion of the margin, they're going to keep all the rest of the margin. So that's the idea where there's a perceived benefit there. In the write-up this week, I point you to a couple of things. First thing is there's actually an article that's archived. I have the link in the materials from 1995 that you can find in the free library website. It is a tax advisor article from 95. It actually discusses this very rule and gives you a series of rulings where the IRS ruled in cases, actually it's cases, rulings, cases, rev rulings, and private letter rulings, where taxpayers succeeded in showing that they had a 162 expense. So that'll be your list. Well, here's the catch in this case. So we have this settled law. So the ruling doesn't actually say, but strongly implies that if you meet this requirement, you will not need to reduce it. So I now I have a business reason for giving the $1,000 to that private school tuition organization here in Arizona. I come up with a valid business reason. Now, by the way, please remember, you've got to meet those two tests. So it's not just going to be, hey, I paid it, so there's a business reason. That arguably won't fly. So I have a business reason. I make the $1,000 contribution. What especially the Treasury Secretary's statement implies is I don't reduce that deduction by the $1,000 Arizona's going to reduce my state taxes. So I get a $1,000 deduction and I still get the credit. And that's going to work great for me if otherwise my taxes, let's say my property taxes just by themselves are over 10 grand. I'm going to get a $1,000 deduction that had I not made the contribution, A, would have been a below the line, not above the line item, but B, because I'm over the limit, I wouldn't have got any of it if I itemized. So that's the concept that's going here. Now the fun starts. Why is this a problem? This clarification is an issue. Well, now here's your problem. As of a couple of weeks ago, we thought we had put to rest all of those programs, New York, New Jersey, Connecticut, those tax credit programs, because under those rules, you couldn't, basically, you weren't going to get a benefit for doing it. So you might as well just pay the tax. Now, though, if you can come up with a business reason, the theory is, at least the way this appears to read, for making that payment to, let's say, one of the New York funds that'll reduce your New York state income taxes, you're allowed to claim that deduction on your tax return, and we don't have any problem with needing to reduce that by what you got as a state credit. So we reduce our New York taxes dollar for dollar, right? Or in this case, in New York, it's 85% of what we paid in. But then we get a full deduction off of our Schedule C income. So because of that, I'm dollars ahead by making that contribution to the state of New York, as opposed to suddenly, being well above the 10 grand cap and having no deduction at all. What that means is, as a lot of people suggested, there was an article in Tax Analyst on Friday, or I should say Tax Notes from Tax Analyst on Friday, where a lot of commentators suggested that apparently we're going to need a clarification of the clarification, because this, if you just take it at face value, we seem to be almost back where we started, except that you need to have a valid business and a business reason with no real guidance yet on what business reasons are. That's kind of interesting, whether we'll have a clarification of clarification to try to explain what credits actually work under this and which ones don't, or if everything works under this. And by the way, the other catch is, you might say, well, there'd be no obvious business benefit in paying into that New York fund. Well, actually, the New York funds are for education and health, so you can still find an arguable business benefit probably to paying to them. But, the New Jersey one might be a little tougher, that would reduce your property taxes. And just when the fund that went straight over to the, went straight over into the general fund for the county. So you wouldn't even just kind of, county, township, whatever we're talking about in that area where you pay the taxes. It wasn't even going into a specify where we're directing it to go to this area. In that case, maybe that's tougher, but it means it should be trivial, though, for even if we say the New Jersey and Connecticut structures don't work, it should be trivial, though, for the states of Connecticut, New Jersey to modify themselves into a structure probably more like New York's that could work, or like Oregon's or California's that are both related to college funding. Those should be a lot easier to structure. And remember, the California one, I'm still waiting to see if the governor signs that. But the Oregon one has already been gone through. So in Oregon, if a business paid for it, and even if we don't worry about the Oregon had the issue of, how we met or did meet that date, but even there, it would appear that the deduction is allowed. And you can easily see a business saying, look at these wonderful things. We're giving money to the state of Oregon to use for college scholarships. And isn't this wonderful? And maybe we need to make some modifications to it because of the way Oregon handles the limits. We can't be sure we're going to get the benefits, but it seems like it's a solvable problem. So keep your eye on this. Remember, those regs are still proposed. We just had what's, for practical purposes, the third shot at this. Remember, the first shot said we're going to try to do it and say that, well, there's no economic substance to the transaction. So form over substance, you're not going to get the deduction. The regs that came out made no mention of that, went over to the quid pro quo rules. Now we have suddenly, well, quid pro quo, but that doesn't count if there's a business reason for doing it. So now in option 3 in this analysis, I expect, as the article in Tax Notes said on Friday, that we're likely to have more clarifications on this before we're done. So keep your eye out for that. And certainly take care. Don't necessarily assume that we now know how everything's going to work, because, hey, it could move again. Next up, let's talk about a Chief Counsel advice here. Chief Counsel advice 2018-35004. This was issued on August the 31st. And this is specialized, but I thought I'd mention it because if it's important to you, it's important, very important. If not, you probably don't care. This involves offshore drilling and seismic studies that were paid to determine the placement of wells in the offshore area. Now, the taxpayer in this case had taken the position that these represented intangible drilling costs. Intangible drilling costs generally, especially if you're a small producer, can be expensed immediately, right? So you write those off. Now, what's IDC? IDC is defined under 263C of the code. But basically, the best explanation that I can give for it is it's kind of the stuff that goes in the well. The old theory that we used to have was that, the stuff that goes in the hole, right? The intangible things below the surface, those are considered intangible drilling costs, and you can expense those immediately. So they're part of getting the hole drilled. Now, so they were saying, well, these payments for the seismic study was to determine the actual place we're going to put the drill and drill the well. So because of that, and they were for exploratory wells, because of that, they're really IDC. Now, the IRS disagreed with that point. And what the IRS ruled in this case is they are geological and geophysical costs. Those are subject to a different rule in the case for being geological and geophysical costs under 167H. Those costs had to be capitalized and amortized over 24 months, which means, yeah, we're going to get them, but over a slower time period than we would if we could just write everything off up front. The IRS ruled that in this case, the key issue here is they did not relate to a specific well. Rather, they were general purpose costs that were incurred. They said they're like standard geophysical and geological costs, and because of that, they should get the 24-month period. They're not IDC because we haven't actually started drilling a well yet. This is just going to help us get to the point where we actually could drill a well by telling us about where we might like to drill. In any event, it's a cheap counsel advice. If you work in this area, obviously you want to get that CCA and take a look at it. You may not agree with it, but at least you want to know what the IRS is thinking. Next up, we have an executive order on strengthening retirement security in America issued by the President on August the 31st, 2018. In that executive order, Department of Labor and IRS are ordered to look at trying to expand coverage for retirement plans. And really this program, and part of this is, please remember, that what they've got to do right now, all you can do with an executive order is make changes that do not require congressional action. Because obviously, if we need congressional action, then we have to go get Congress to do something. And clearly that's, that's easier said than done in many cases. But what they suggest they do is they want to look at simplifying the situation for multi-employer plans. One of the real problems we have with multi-employer plans is the bad action of one member of the multi-employer group could disqualify the entire plan. They want DOL to look at whether or not they could remove that rule. In essence, can we isolate the one bad actor and not have to blow up the whole plan? Because they'd like to expand that, the idea being if we have multi-employer plans, that reduces the administrative cost for each employer. And so for that reason, small companies that currently aren't adopting plans would, in theory, be willing to adopt them. Now, I will admit to a bit of skepticism on that point because a lot of my clients that don't have 401k plans, don't have them because they don't want to mess with the payroll tax side of the equation, right? Which is all the mess of withholding and putting it in. And they're not really interested in other plans that they're going to fund entirely. So I don't know, but I suppose there are some where, yeah, we're okay with the payroll tax withholdings. We're okay with the transmittal to the custodian, but we don't want to deal with those other things. And they're not small. So it probably makes a difference at the edges. So it's not a bad idea if, in fact, the Department of Labor can get it to work. They also want to simplify down notice requirements and especially allow them to be issued electronically in all cases. Whether all notices had to be given. If you've ever done plan work, there are a ton of notices that are given for various things that happen. Most employees have no idea what they're reading, but they got the notice, so they take it, they toss it. And as most of us know, quite often, if they ever do anything with it, they give it to us, like 8 months after they've already done whatever they're going to do, rolled over or not rolled over, after which case, who cares, right? Those issues. Finally, and this one, the IRS and Department of Labor can act on probably more quickly and more directly. They want to look at required minimum distribution, specifically looking at should the life expectancy tables be revised and how often should they be? Most likely, if they revised them and updated them today, that would slow out the payout period. Again, for clients who are just taking the RMD every year and never go above it, this would allow you to slow up that payout. So again, that one they could do. Now, they supposedly have 6 months to get back and tell the administration, what they're going to do about these things. So I would suspect if we're going to get a change in RMDs, it would probably be for 19. I don't see this happening where you can change the 18 number. I also have a feeling they don't get done very early in 19. They won't change the 19 number because there's always a concern about people who've taken the money out already. And, do we have to give them a chance to put it back in if they went over the limit? If they went over, I should say, what the minimum was. If they say, wait, well, I now don't want to do the minimum, I want to keep the money in there. Would they be allowed to put it back in? That's complicated. So my guess is if we see this, we may see it right at the beginning of 19. It would apply for 19. If they, in fact, don't get around to it, because, oh, by the way, the IRS does have fewer things going on, then we may very well see it announced in 19, but effective in 20. But again, keep your eye on this because, again, these sorts of things, I mean, there's an executive order. They are supposed to pay attention to that. So we need to figure out what they do with it. Finally, the IRS had a loss in court this week. This is the case in tax court of Toso et al. Versus Commissioner, 115 TC number 4 on September 4th of 2018. This case involves passive foreign investment company gains on disposing of the stock. Under special rules found at section 1291, if you have a gain on disposing of passive foreign investment company stock, we allocate that over the time period you held the stock. But if you held the stock, let's say, therefore, for a period beyond this year, so you've got these what would normally be long-term gains, what we end up doing instead is we allocate it based on days. So let's say that you held it, 1/4 of the time you held it was in 2018. That 1/4 of the gain will be taxed in 2018 as ordinary income. But then the rest of the gain will there'll be a separate tax computed using prior years and just added to your tax on the return. Now, this gets involved with the issue of the IRS, in this case, taxpayer had not reported the gains they should have. The taxpayer, of course, now this is the thing missing. The question becomes, if the taxpayer didn't include those gains, does that constitute an omission of income, which could trigger the 6-year statute under section 6501E1A? Remember, if we have a substantial understatement of income in excess of 25% of the amount of gross income that should have been on the return, then the IRS has 6 years, not 3 years, to assess the tax. The IRS said, look, it's not just that part that's treated as 2018 ordinary income, but all that other part has to count toward the 6-year statute. So the IRS said, even though it's not in taxable income, because by the way, only the current year part ends up in section 61 gross income. The IRS said, but obviously the rest of this counts too. The tax court said, we're not sure it's so obvious. The court said, look, the plain language of the statute talks about gross income. Gross income is defined by section 61, and 1291A takes everything related to before the beginning of this year on this gain out of gross income. So IRS, you can't count that portion. And so because of that, the IRS only got 1 year of the 3 years they were going after were they able to use the 6-year statute. The issue becomes, in that year, the current year gain was large enough to push them over the 25% limit. Now, the taxpayer didn't win everything here. What also happened in this case was the taxpayer tried to argue that 1291 losses should offset the gains for this purpose. And the tax court said, no, you got the same problem. The law clearly says that the losses stay as capital losses. You only get $3,000 a year. You can't net them against your 1291 gains. They said, when we say the statute, okay, maybe that's a crazy statute, but you know what? It was crazy on the 6-year rule, and it's crazy here. But that's the way the statute's written. If Congress doesn't like this result, Congress can change the law. Now, as I noted, this is a published tax court decision. That does mean if you have this situation in the future, the IRS is going to be bound by the same rule. At least the tax court is going to say it. We'll see if the IRS tries to appeal this. The IRS argues, well, this is crazy policy. And the court said, crazy or not, Congress can pass crazy policy. That's not really our problem. Well, as we said, we're getting in the middle of all these deadline times. And I know I'm having fun with them, and I'm sure all of you are. But, take a little bit of time now, at least, you maybe get a little breather here this week, maybe a little bit of time over lunch, and take a look at your state CPA Society courses for the end of this year. There is a lot that's happened this year. We mentioned some of it here in today's session. We're going to obviously have, again, the clarification of the clarification is going to come up probably at some point. be sure that you sign up and take a look at those state society courses. It's a great place to network with other CPAs. And to be honest, the other good news is you have an instructor who is up there and who essentially is making sure in almost every case that they are keeping up with what's happening now. So unlike a recorded presentation that you might take where, oh, good, I'm going to watch this tape session that was recorded 6 months ago. Well, that's not going to keep you up to date. You want to take a look at those live courses. That's the main advantage. That's a huge advantage of them. In addition, be able to interact with people themselves. Finally, this week, I'm going to announce one other thing here. It's not a big deal, but so nobody gets confused. We are now effectively changing the name of what we all do here in terms of the Kaplan side of this. And we're still part of Kaplan Professional Education. But you may have been aware over the times that, the Kaplan accounting continuing education stuff, some of it came from Smart Pros. Self-study. Some of it came from the EEI, in essence, the Executive Enterprise Institute. Some of it came from Lascalzo, the Lascalzo Institute, which was the ANA live training. And then, hey, where I came from, the Nichols Patrick was where the tax stuff came from. All four of those now names, all four of those entities, let's say, or groups, are going to now go under the new name of Kaplan Accounting Continuing Education. Right, part of Kaplan Financial Education. So we're just changing the name. It's still the same groups. It's still the same thing. It's still the same people. But we're going to change the name. Those of you who know who've been involved with me or have taken courses from me, I, of course, have been calling it Kaplan Financial Education for quite a while. It's now going to be officially a Kaplan Accounting Continuing Education. So just be aware if you see that, yeah, it's still the same people it was for Lascalzo. It's still those of us that did Nichols Patrick. It's still the same group. Nothing's changing in that regard, except we're going to get one single Kaplan name. This has been the Current Federal Tax Developments for this week. It should be a fun week. Be sure to catch our updates that go online at currentfederaltaxdevelopments.com. If you have any questions or comments, you can email me, Ed Zollers at currentfederaltaxdevelopments.com. You can follow me on Twitter at Ed Zollers. I post there whenever I post an article on the website. I post there. Then I also do some other commentary from there. Sometimes I'll find an interesting article or an interesting citation, and I'll do, I may retweet something there that I think is useful tax-wise. I do not use that generally to put my personal things there, so you're not going to find out what I had for lunch that day, or other neat things. I'm not going to tell you about all my political leanings and all of those things. This is just pretty clean tax, tax developments feed, so you can watch that there. You can also follow our discussions. I follow discussions on various discussion groups on the subreddit of r/taxpros, the Tax Pros subreddit on Reddit. I also follow on the Tax Talk discussion group on Yahoo Groups, which is what the California Society of CPAs runs. I participate in Arizona Society's group, so if you're an Arizona member, you can sign up for their group there on the Connect site. Also participate in the New Jersey Society of CPAs. I'm whatever we call ourselves, the members there that aren't licensed in New Jersey, but do things. I lecture there, so I'm also on that one. And I've joined there, so I'm part of New Jersey Society. We have their Connect group. You can find me there. Any of those places you can find me, and those are useful places also, just to get input from other people on the issues you may be facing. Well, as I said, it's been an interesting week, and it's been a big, full week. We're going long this week because there was a lot there. Be sure to join us next week. We'll talk about what comes up in federal taxes and all the neat things happening, and maybe even more clarifications will come up next week. So, hey, you never know. We might be able to actually clarify the clarifications. So hopefully I'll see you next week here on Current Federal Tax Developments.